and welcome to this edition of All About Your Company. I'm Harsh Saita. Very quickly, today we're going to be talking about a company which is in the power space in India and renewable power at that. Recently IPO'd, in fact. It's Enviro Infra we're going to be talking about. Since the IPO price, the stock has come off quite sharply as well. IPO was subscribed around 0.94 times. And there's a huge capacity expansion which is at play. In fact, their current capacity is at 3 gigawatts. Over the next 2 years, that capacity will reach 5.7 gigawatts. So you'll see a very large expansion. Graded, of course, FY27 end, what they will do is 4.5 gigawatts, and thereafter they will add the balance. And likely it will be more than 5.7. The current pipeline is for 5.7, and the current pipeline is what is contracted. In terms of the products, firstly, the company is in the renewable energy solution space. It was incorporated in 2010, just kind of taking a step back. It's an EPC plus power generator, and EPC they also do O&M to some extent. I'll take you through first the products, then the business model. So in the renewable energy space, they contract with clients which are in the industrial stroke commercial kind of customers. That's what they currently deal with. In terms of the business model, they build plants, own assets, and sell power. Long-term power purchase agreements are entered into, and the average tenure of these agreements is roughly 23 odd years. The tariffs are fixed and thereafter, and obviously subject to escalations, but they're significantly below grid and industrial tariffs. So, and therefore, they are able to stand out versus some of their other competitors, because grid power is more expensive than the power that Clean Max is able to generate for its customers. In terms of, and it's significantly below, in fact, that's what the management has said. In terms of the model, they operate across the board. One is group captive, where a bunch of customers get together and build a captive power project. Second is third-party open access, where open access is given to third party as well. And third is on-site supply, which is they themselves, basically there is a particular site where for which the power is specifically generated and catered to. So they basically operate across the board. In terms of other energy services, they also provide that. The customer funds the capex in this kind of a model. Clean Max executes it as an EPC or a turnkey project. There are long-term operations for which operations and maintenance is done by Clean Max, and services obviously generate a fees. And here the capex is extremely low, which is a positive. And basically the revenue is very, very sustained, and that there is a very good glide path with regard to understanding as to how the revenue will play out for assets like these. So that's the second piece of the vertical which Clean Max focuses on. The third one is environmental attribute purchase agreement. Now I'll try and quickly explain it. It's nothing but carbon credits, but in carbon credits what happens is your carbon footprint is really monitored. In an EAPA, which is environmental attribute purchase agreement, the quantum of green energy that you're utilizing is what is monitored. So you get credits for the amount of green energy that you produce, and therefore what Clean Max can do is sell those credits in the market, and that's how generally this works. Now in terms of capacity, and I did highlight the capacity, and very quickly I'll continue to give you a quick lens. 5.7 gigawatts is contracted. As of 1st March, 3 gigawatts is live. 2.7 gigawatts is contracted as of today, which will come live in the next 2 years. 1.5 gigawatts of this 2.7 will come live by the end of FY27. Now, in terms of geography, it deals with India, Bahrain, UAE, Thailand, but predominantly India. They've not given us the revenue mix based on geography, but they are diversified in that sense across geographies as well. In the India mix, there is Karnataka, which is 30%, Gujarat, which is 20 to 30%, and others is around 20 to 30%. That's how the broad split is. Now, let's talk about the financials, and let's see how the growth path has been. It's been extremely strong, of course, off a very low base. You've seen 30% growth on the top line over the last 3 years, and that will likely continue because you'll have another 50% capacity addition by the end of FY27, which will come on stream FY28. And thereafter too, you have 1.2 odd gigawatts on top of that, where there is visibility as well. So another 25 odd percent from there. Now let me talk to you about EBITDA, and this is where you'll see the numbers again stack up very, very sharply, 45% higher on EBITDA. Now where the problem comes in is profit after tax. It's not grown at the same clip because you started to see debt come on the balance sheet. Mind you, power producers generally also have a debt of 4 times EBITDA, 4-5 times EBITDA is very, very normal. Debt to equity is very, very normal, and that's because there is a visibility of cash flows when you're generating energy and when you have assets which are generating steady energy, right? And therefore, while the rates of the cost of debt is far lower, but the quantum of debt is very, very high. And generally, when you're a smaller company, that debt weighs on the balance sheet and the P&L. That's what you're seeing on the numbers here, that the debt is really what is weighing on the P&L. Both depreciation as well as interest costs are what is deflating profit after tax. When you see the margin trajectory, it's going upwards. It's at 62% currently, and there is further scope for expansion. In fact, energy production margins are at around 83% currently. The goal is to get to 85 to 86% soon, is what they've said. They've not given a timeline. We'll try and get a timeline from them in the conversation that we have today. But that's on the margin front. So clearly, the visibility on margins is also better. I spoke about the 4:1 on debt to equity. You're seeing that on the balance sheet currently. 10,000 crore of borrowing versus 2,500 crore of book value currently. What you're also seeing is the company has cash. That's important in terms of the element, given the quantum of debt that there is there, and the quantum of capex also, which is likely to come on stream. Around 1,100 crore of cash is what the company currently has. In terms of cash flow, well, the conversion of EBITDA to cash flow is fairly smooth in most years. You're seeing that chunky sometimes, but otherwise it's nearly there, and therefore no concerns with regard to cash flow. When you're talking about ROCE, you're seeing single digit, and that's where some bit of the disappointment comes in. You're seeing single digit ROCE, which is a problem. But as scale kicks in, the guess is margins will get a lift, debt will remain the same, and therefore interest cost will not go up. While the top line goes up, margins continue to expand, and you'll start to see that trickle through on the bottom line. That's broadly the way one sees it. We'll obviously ask management to understand better as to how they see the business and how to look at return ratios. But currently in single digit is what the return ratios are. We're slightly cautious with regard to that number. You look at the promoters, they own around 50%, no concerns there. FIs, DIs have a healthy mix. Even in the IPO, the QIB participation was very strong, and therefore just public just owning 5% of this for now. Of course, this makes things difficult in terms of instis holding so much, and therefore they will likely want exits at some point. But for the moment, we've given this a thumbs up, from at least a shareholding standpoint, because promoters own 50%, and then there are big instis which own as well. Let's talk a little bit about the stock performance. I'm not going to rate that, but broadly, when you're looking at the stock performance, you're seeing that the IPO price was 1,053. There wasn't enough retail participation. In fact, just 0.9 times subscribed, and the current price is at 860 rupees a piece. That's broadly the take. IPO to now, the stock is down around 18%, and that's one of the reasons why this one makes it interesting. When you're looking at valuations, the current PE is around 185x, but of course, you've got a very strong tailwind of growth. Acme Solar, in a very similar space, has a little bit more of battery and energy storage solutions to its bouquet of services, is what my analyst tells me, which is current. But broadly, 33 times is what Acme Solar trades at. But Clean Max has a far stronger runway of growth because of the quantum of pipeline that you're seeing there, and therefore it will be interesting to see how the valuation there on Clean Max actually compresses, and we'll understand that slightly better when we speak with management. In fact, let me quickly dive into a break, come back, speak with management on the other side of this break. Stay with us. Thanks for staying with us. Let me bring on board Mr. Nikunj Gadhvi, who is the CFO, Clean Max Energy Solutions, joining us this afternoon. Nikunj, great having you. Nikunj, let me start off with the 1.5 gigawatts that you're going to be adding in FY27. Is it going to be a phased increase towards 1.5? Is it going to be a one-shot increase? When is it going to happen? When does it start translating to revenue? And how much of revenue addition happens? Give us a sense of all of these. Nikunj, could you please unmute? I believe you're on mute.
Hi, Harsh. Am I audible now?
Hi. Yes, very much. Please go ahead.
Thank you. Thank you. Thanks for having us, and thanks for the quick background about the company. I think your first question is on the 1.5 gigawatt guidance. Perfect. So we primarily have two segments. One is the ASTU segment and a CTU segment. As we said, 1.5 is the total capacity we'll be building, at least in the coming financial year. So this is across multiple projects and not one project. So that's why this capacity will come in different phases across the year. So you'll see capacity addition every quarter, and you'll also see some projects coming in one particular quarter. So there'll be lumpy additions as well. So it'll be a consistent sort of addition over the year, but it's difficult to give a specific quarter-wise breakup because it's project by project and it's multiple projects. It's double-digit projects which we'll be developing over the next 12 months for this 1.5 gigawatt.
Right, and therefore, Nikunj, how should one see your top line evolve? You're currently doing an annualized top line of around 16 to 1700 crore, if I've understood it right. How much would that jump by, say, in FY27? What's the target?
So the way to look at it, Harsh, is that it's a fairly simple business. What happens is that what we built at the start of the year is what would be primarily be the contributor of the top line as far as the energy sales segment is concerned. So if you see the 3 gigawatt is the build capacity at the start of this financial year, which is, if you see as on 1st March, which was the number which it given to the street, that 3 gigawatt is a build capacity. So that 3 gigawatt will primarily be generating the energy sales revenue. And we also indicated or gave our the steady state run rate EBITDA on that 3 gigawatt, which is already shared as part of our quarterly result. So that would be the primary contributor of the energy sales revenue. Whatever we build during the year, project also has stabilization phase and also that will add to what the run rate number sort of we have given at the start of year. The second thing is, which is the second segment, is the sort of EPC part of our business where we do the EPC and customer do the capex. And that part, it's again, you historically seen that the revenue on that side is in the range of, say, somewhere between 300 to 500 crore, depending on what order book and execution we have. So right. That is a consistent delivery on the EPC side you'd see in that range. And then energy sales, which is the primary contributor of EBITDA and revenue, it's fairly straightforward to estimate based on what is the current operating capacity at the start of the year, and then there's some addition to that over the year.
So Nikunj, therefore, if I were to just try and build all of this into a model, what will the revenue look like for FY27?
See, again, I would say that it's rather than me giving a number on a revenue, we already have indicated that energy sales run rate EBITDA, when we talked about our last quarterly result for the build capacity, is around 1800 crore. That's the energy sale run rate EBITDA, which we already talked about when we published our last quarter result, right? And energy sales is 83% EBITDA margin business. Right. So that's sort of very easy to understand that is the contracted energy sales EBITDA and run rate, and which is also built today. So what is built and contracted already is the start of the year number. And based on that, it is easy to extrapolate to the market versus we are trying to give a number here.
So, Nikunj, let me get this absolutely right. You're saying that EBITDA from power generation or power sales will be 1800 crore for the financial year FY27. Am I understanding this right?
Just a little bit of a clarification on that. So what we said is that this is the capacity which is built and that is the EBITDA that capacity should generate as it fully stabilize, right? There can be some, so that's the run rate EBITDA on that 3 gigawatt which is built as on 1st March 2024. Of course, if those are built capacity and that's the run rate EBITDA that eventually will translate into on a full year basis that kind of a EBITDA. And the only caveat here is, which also has very in detail explained into our presentation to the street, is that there is a stabilization period, and on a fully steady state basis, when fully stabilized, that's the kind of EBITDA it would generate.
Excellent. Okay, Nikunj, I'll unpack this a little bit for the viewer. So, what an 1800 crore EBITDA will, on a steady state, would likely mean is around an 83% EBITDA margin at which you're doing on the 3 gigawatt of power that are generating currently, which will mean around 2200 to 2300 crore of top line, right? I mean, that's the right way to think of it, right? Correct me if I'm wrong again.
Steady state basis on energy sales segment. Yeah, if you just do the back calculation, that's what it is.
On O&M and the like, you'll do another 500 crore, EPC plus O&M.
I'll just say that historically that's been the range for us, which is and that business is 16 to 18% kind of a margin if you see historically.
Correct.
Right?
Correct. And what's the growth clip there like? Because there you have visibility as well, Nikunj. So what's the order book looking like over there? What's the growth visibility there looking like?
So the way, Harsh, this business happens is that when we contract, typically we have for a solar project 6 to 8 months to build, and for a wind project 9 to 12 months to build, right? And the revenue realization is always based on the how the construction or percentage completion is, right? So the current order book which we have may not be that meaningful, because over the year also we would sign and we would continue to build it for the client, and what percentage is constructed based on that revenue get realized. So that's why it's a EPC part of that is very difficult to say revenue or EBITDA number. But what is I would say fair to say is that historically the range on that has been 300 to 500 crore, and we have generated on an average 60 to 80 crore of EBITDA from this segment on most of the years in past.
Fair point. So that takes your EBITDA on the existing 3 gigawatts itself to around 1850 crore on a very conservative basis, right? And that is FY27. What happens FY28 therefore? Give us a sense of that, because what will happen is your 2200 crore, 2300 crore odd top line that we spoke about and 1800 crore on EBITDA will likely go up by 1.5x. Is it going to be a linear increase of 1.5x, given that you're going to add up a gigawatt and a half in FY27, all through FY27?
So in FY27, as we said, that we build 1.5 gigawatt, and once that 1.5 gigawatt is built, that would translate into the EBITDA for FY28. So that's a very fair statement to say that the EBITDA for FY28 would be 3 gigs built plus 1.5, which we hopefully will build in FY27. So that becomes a 4.5 give and take. So that would be the EBITDA run rate for the start of FY28. Also on 1.5 gigawatt, we have in our presentation given the breakup in terms of what is the contracted tariff of 2.7 gigawatts. So 3 gig is built and 2.7 is contracted. That also at a very, I would say, handsome tariff of 3.84 rupees per kilowatt hour, which is again a public information. So that 1.5 gig will be at that kind of a tariff, let's say on a weighted average basis. So then, and our PLF numbers for the wind and solar are also there, so that can be back calculated. So I would say that it's a simple math versus we're trying to put in a number.
And how much of capex required, Nikunj? Give us that visibility. First off, for FY27, given that you have a build of 1.5 gigawatts left, maybe part of that build is left, but then thereafter as well, give us the 2.7 gigawatt for which you have visibility. What's the capex quantum looking like?
Sure. So on Before we get into the quantum, I'd like to say that when we raised this capital from the our IPO, which was a mix of some primary and some secondary, and there were different end uses of that. So based on that fund raise and current cash in the business and what business generates on a regular basis, so as a combination of that, we are fully funded for that. So that's absolutely not a question here. So if that's what we're trying to solve for, then the business is funded for that 2.7 gigawatt and beyond also for what is built and for what the cash is raised basis that. Now, on an average, currently, because capex also is sometime a function of how the equipment price movement has been. But given that for FY27, we fairly have contracted most of the capacity which we are building. So based on that, we know that wind projects typically cost around 7.5 to 7.6 crore kind of a range per megawatt. And a solar project, because we have a widespread portfolio across the country, it's in the range of, say, 3 to 3.3 crore kind of a range as a build per megawatt. And historically, our mix between solar and wind has been 70% solar and 30% wind.
Okay, okay, okay. That I'll do that maths. But while I'm at it, give me a sense. Therefore, so you're well funded from a capex perspective.
That's
what do you
right.
do with the EBITDA coming in, right? And what's your cost of debt currently? My understanding is you do around 700 crore of interest cost every year. Correct me if I'm
Right.
wrong. Whether that continues, increases,
So-
reduces. So you're well covered. Your EBITDA covers your debt, at least your debt servicing cost by 3 times. That's my understanding. Again, 2.5 odd times. Correct me if I'm wrong there as well. And therefore, what happens to the cash flow that you generate?
Sure. The two things happen that any debt we take, right? See, it's a capital intensive business. So every project we build has to be built with the mix of debt and equity, right? For us to ensure that we create an attractive return for the equity shareholder. So then any debt which is there, which is taken on the balance sheet, it's backed by a cash flow, which is the project level cash flow. So absolutely right in saying that the debt is well covered because debt is coming for a project which is generating a cash flow. So it's in that sense, a debt is always backed by a cash flow. And if you see the capacity, which is 3 gigs, becomes 5.7 gigs because contracted is to another 2.7, or obviously a corresponding debt need to be taken to build that capacity. Though the equity side we are well funded, as I said, but the corresponding debt will also come in, and hence the on absolute terms, you'll see that the debt profile would keep on increasing because we are a fast growing company. So every megawatt we add would translate into some addition to the proportionate addition to the debt. And the way this works is that our contracted cash flows are typically 23 years uh, on an average for the entire the contracted portfolio. So it's a 23-year contracted cash flow. Against that, the average tenor of the debt is, say, 18 years or 19 years. So then in that sense, the cash flow which gets generated is used to repay the interest and also then used to repay the debt annually, which is amortization of a debt annually. So the debt profile
Understood.
in that sense keeps on reducing, and thus it sort of becomes a sort of the way to think about it, that as asset keeps on maturing, your cash flows and ROE keeps on increasing because your
Understood.
interest is continuously reducing. So that's what we are going to do
Understood.
with and whatever is remaining, let's say, because our debt servicing with interest and principal both, still there is a cash flow remain, right? Because our debt service are of course very
Correct.
healthy. Uh,
Correct.
so that is given we are growing at a fast pace, that also get used for the deployment into the future growth, right?
Understood.
So that's the way. So as long as we find the growth opportunities attractive, we would redeploy it.
Right.
Right? There would be a time
Understood.
if we see that the growth opportunities are not attractive, then the question comes that should there be distribution to the shareholder?
So your debt to equity, Nikunj, I have just 30 seconds. Your debt to equity, therefore, will always be stretched in that sense because that's the nature of the business. That's what you're saying. Also, from the math that I've done for the 2.7 gigawatt setup, you likely have to do around 10 to 11,000 crore of capex. Given the numbers that you've given me per megawatt, 7 crore for wind, and per megawatt around 3 to 3.5 crore for solar. Broadly, is that the right way to think of it? And that will then be split between debt and equity based on whatever you've just said?
Yeah, so as I said, that's the per megawatt cost to build this. But let me first answer the debt and equity part which you raised. See, you have to see the debt and equity relative to this industry, right? So who are the relative benchmark, which is the other renewable energy utilities company, right? So the listed peer and what's the debt equity profile there and ours, and you'd find that given our cash flow per megawatt, given our tariffs are higher compared to the utilities player, is better, and the build cost is same, that the ratios on the leverage side are more conservative compared to the industry, right? So that's the point to look at it. That so I would not say the debt to equity is a stress, which word you used. I would say rather it is well balanced, because in a capital intensive business, you have to have the right mix of the debt and equity both to generate the
Correct.
right kind of equity
Correct.
returns. So that's the way I
Absolutely.
would Harsh play. And the cost,
Agreed.
the
Thank you so
question
much,
you
Nikunj.
raised on cost of financing, current cost of financing at a project finance level is 8.7% for us.
8.7%. Perfect. Thank you so much, Nikunj. You've been very candid, very comprehensive. And viewers, unfortunately, all the time we have. So we're going to have to thank and say goodbye to Nikunj, and goodbye to you guys as well. Thanks so much for tuning in.